Ever had one of those moments where you're like, wait, this wasn't in the brochure? Like, you buy a beachfront property and it turns out high tide reaches the front door. Well, today's deep dives is kind of like that, but instead of dodgy real estate, we're wading into the wild world of UK property taxes.
And let's be real, sometimes those tax codes can feel as daunting as a rogue wave.
Tell me about it. Specifically, we're tackling those moments when your UK rental property is throwing shade in the form of losses, not profit.
Ah, the joys of property ownership, right. The thing is, even if your rental isn't exactly raking it in, HMRC still expects their cut.
It's like they always say, taxes and, well, you know the rest. But fear not, dear listeners. Today, we're channeling our inner tax sleuths, armed with HMRC's Property Income Manual. And believe me, this manual is denser than a fruitcake. Our mission, to figure out how to potentially offset those rental losses against other income. Think of it as financial first aid for your tax return.
I like the way you think. Now, our source tells us there are essentially two main roads we can go down when it comes to finding relief for those pesky rental property losses.
Okay, lame on me.
Option one is setting those losses against any future profits you make from your rental property. So it's like banking those losses now to use later. Option two is setting the losses off against your general income.
Ah, two very different flavors of relief. So option one, setting losses against future rental profits. It's like stashing away a rainy day fund, but for your tax bill.
Precisely. You're essentially carrying those losses forward until they're fully balanced out by future profits from, and this is key, the same property business.
Same property business, you say. Now that piques my interest. What if someone's got multiple properties? Asking for a friend, of course. Let's say they've got a flat in London and a cottage in, the Cotswolds. Are those considered the same business?
Great question. And that's where things can get a bit tricky. HMRC would likely see those as two separate ventures, meaning you couldn't use losses from your trendy London flat to offset profits from that quaint Cotswolds cottage.
So each property is its own little island, tax-wise. Interesting. Now on to that second path you mentioned, setting off losses against general income. This sounds like the fast track to tax relief, right?
Well, not quite a free-for-all, unfortunately. It's a bit more, shall we say, exclusive. It only applies to losses linked to two very specific things: excess capital allowances or agricultural expenses.
Okay, hold up. Excess capital allowances. That sounds like something you'd need a secret decoder ring to understand.
It's not as complicated as it sounds. Think of it this way. You buy a swanky new appliance for your rental property. Over time, that appliance loses value, right?
Sadly, yes. Everything seems to depreciate these days.
Exactly. Capital allowances are basically the UK tax system's way of acknowledging that wear and tear. They let you deduct a certain amount from your taxable rental income to account for those depreciating assets.
Okay, I'm starting to see the light. So, if those capital allowances end up being more than the income your property generates, you've got yourself an excess. And that's what can potentially be used to offset losses against your other income, right?
Bingo. You're a natural at this. And it's the same deal with agricultural expenses, though obviously that only comes into play if you're letting out farmland, which, speaking of, we'll dig into a bit later. But the main takeaway here is that you can't just offset any old rental loss. It's got to be tied to those excess capital allowances or agricultural expenses. Those are your golden tickets.
Right, got to have those special ingredients for the tax relief recipe. Now, our listeners love a good real-world example. Could you walk us through a scenario from our trusty HMRC manual?
Absolutely. Let's look at Aaliyah's case. She owns a real mix of property, shops, factories, even some farms, all rented out, all above board. Now, one year she ends up with a £50,000 loss on her rental business. Ouch, right?
Poor Aaliyah. That's a hefty chunk of change to be down. I bet she's hoping to offset at least some of that against her general income.
Exactly. Now, here's where it gets interesting. Out of that £50,000 loss, £25,000 is from capital allowances, and another £7,000 is from, you guessed it, agricultural expenses.
Okay, so those are the magic words we're looking for. But how does that actually shake out when tax season rolls around?
Well, instead of carrying forward the whole £50,000 to chip away at future rental profits, she can potentially offset a combined £32,000 against her general income for that tax year. That's the £25,000 in capital allowances, plus the £7,000 in agricultural expenses, the leftover £18,000. That gets carried forward just like with that first method we talked about.
So she's getting a bit of a two-for-one deal, Immediate relief on a big chunk of her losses, and then the rest is stashed away for a future tax break. Not bad, Aaliyah. Not bad at all.
Exactly. This just goes to show how understanding these little nuances can really pay off.
Okay, so we've covered the what and the why of setting off losses against general income. Now let's talk about the how. What does someone actually have to do to claim this type of relief?
Well, the most important thing is timing. You've got until the first anniversary of the 31st of January following the end of the tax year you're dealing with. So let's say for the 2023-2024 tax year, you'd have until the 31st of January 2026.
Plenty of time to brush up on your tax law then.
Precisely. And the claim itself is usually just included right there in your tax return, or you can submit it as an amendment if you need to. But, and this is a big but, even though claiming loss relief against your general income might seem like a no-brainer, it's not always a simple choice. It's a bit like a game of dominoes. You make one move, it can trigger a whole chain reaction.
Okay, now you've got me intrigued. What kind of chain reaction are we talking about here?
Okay, imagine you're staring down a 30,000-pound rental loss with 35,000 pounds in net capital allowances. You're thinking, jackpot, time to cash in.
Yeah.
But not so fast. Claiming that whole amount might actually reduce or even completely wipe out the benefit you'd normally get from your personal allowance.
Ah, I see where you're going with this. So, by going all in on that loss relief, you could actually end up paying more tax in the long run.
Exactly. It's all about finding that sweet spot, that balance between short-term gain and long-term strategy. Sometimes carrying forward more of that loss to protect your personal allowances might be the smarter move.
This is why I leave taxes to the professionals. They can help you weigh all those factors and figure out the best approach for you. But for now, let's circle back to those agricultural expenses. There are a few more interesting details in our HMRC source about them.
Absolutely. Agricultural expenses, they're in a league of their own. Like, did you know you might be able to claim relief for them even if the agricultural land itself isn't actually making a loss?
Hold on, really? That sounds like some next-level tax wizardry.
Let's say you've got that swanky flat in the city bringing in a tidy profit, but you've also got a country cottage with some agricultural land. And that land, it's not exactly a cash cow. It's barely breaking even.
Okay, I'm following so far.
Now, even though that land is technically generating some income, those allowable expenses, stuff like maintenance, repairs, insurance, all that jazz, they might be exceeding that income.
Interesting. So even though the land isn't in the red, you might still be able to claim relief because the expenses are outweighing the income.
Exactly. And the amount of relief you can claim is capped. There's always a catch, right?
There's always a catch. So what's the magic number?
It's not just one number. It's actually the lowest of three. Imagine it like a limbo contest. You can only go as low as the bar allows.
I like the analogy. What are the 3 limbo bars in this scenario?
All right. Bar number 1 is your total rental business loss for the year. Pretty straightforward, right?
So far, so good.
Bar number 2 is the total of all your allowable agricultural expenses. But here's the real kicker. Bar number 3 is your general income for either the current or the following tax year.
Okay, my brain is doing a limbo dance of its own, trying to follow along. So let's say, hypothetically, my allowable agricultural expenses are through the roof, like 20,000 pounds worth, but my general income for a year is a measly 10 grand. The most I could claim is that 10,000 pounds.
You've got it. You're a natural at this. It's all about finding that limiting factor, that lowest bar that determines how much relief you can actually snag. And this is where knowing the ins and outs of these rules can make all the difference.
This is why we do these deep dives, right? Uncovering those hidden pathways to potential tax savings. But I have a feeling we're just scratching the surface when it comes to agricultural expenses. What else do our listeners need to know to navigate this particular field?
You're right. We've got to make sure we're all speaking the same language. HMRC loves to throw around terms like agricultural estate and agricultural land. But what do they really mean?
Yeah, let's clear up any confusion before we go any further.
So an agricultural estate boils down to any land, and that includes any houses or buildings on that land that's managed as one unit and includes agricultural land.
So like a farmhouse and all the fields where they're raising sheep would be considered an agricultural estate.
Precisely. Now, agricultural land itself, that's defined as land, houses, or buildings in the UK that are used mainly for husbandry.
Husbandry. Is that some fancy HMRC jargon I need to be aware of?
Think of it as a fancy way of saying farming, growing crops, raising livestock. You get the idea.
Right. So we're talking about land where you could film a tractor commercial. Got it.
Exactly. But here's where it can get a little tricky. If you've got an estate that's part agricultural and part something else, well, those non-agricultural bits, they don't get to join the party when it comes to this specific relief.
So if you've got a sprawling estate with a working farm, but you've also got, say, a go-kart track and a private zoo, those leisure-related expenses wouldn't exactly fly as allowable agricultural expenses.
You're catching on quickly. It's all about drawing those lines in the sand, or should I say the soil.
I like it. So it's not just about whether the land is making a profit, but whether the expenses related to that land are higher than the income it generates.
You got it. And just to make sure we're crystal clear on what flies and what doesn't in the world of allowable agricultural expenses, let's look at some specific examples.
Because sometimes those devilish details are lurking in the specifics, right?
Exactly. One big one that trips people up is interest payments. It seems logical, right? Interest on a loan you took out to buy agricultural land, that should be an allowable expense. But HMRC says, nope, not so fast.
So those interest payments, they don't get to join the exclusive club of allowable agricultural expenses.
Afraid not. It's one of those quirks that often catches people off guard.
It's like finding out you can't use your store credit at the coffee shop, a bit of a buzzkill. Okay, any other common culprits that people often mistakenly lump into this category?
Rent and rates are two big ones. You might be paying rent on a piece of land to use for agricultural purposes or forking over council tax on that charming farmhouse. But those specific costs, they don't get to wear the allowable agricultural expense badge.
So it's like they always say, read the fine print, or in this case, read the HMRC guidelines very carefully.
Couldn't agree more. Now, to really bring this all home, let's look at some real-world scenarios, shall we? Numbers always make it click a bit better.
Let's crunch some numbers. Hit us with an example.
Let's take Bran. Back in the 2015-2016 tax year, she had a rental income of £1,000. But she'd also been carrying forward some losses from previous years, a cool £5,000 worth. And here's where it gets juicy. She also had a rental business loss of £12,000 in the 2014-2015 tax year, all thanks to those capital allowances we talked about. She's hoping to use all of this to her advantage.
Okay, so we've got losses from previous years, current year rental income, and a previous year's loss related to capital allowances. This is where that trusty tax advisor would come in handy.
Right, but don't worry, we'll break it down. First things first, any losses you're carrying forward, they get first dibs. They're offset against any rental profits for the current year.
So in Bran's case, that £5,000 she's carrying forward would be used to offset that £1,000 rental income she made in 2015-2016, right?
Exactly, which leaves her with £4,000 in losses still to carry forward. Now, let's say she's got £10,000 of what's called relievable income from her day job. This is where that £12,000 capital allowance loss from the previous year comes in. She can choose to offset some of that against her general income, but there's a limit. She can't offset more than her relievable income.
So even though her capital allowance loss is £12,000, she can only offset £10,000 of it because that's all the relievable income she's got. It's like trying to fit a square peg in a round hole. You can only push it so far.
Perfect analogy. So the remaining £2,000 of her capital allowance loss gets added to the £4,000 she's still got to carry forward from those previous years, giving her a total of £6,000 to carry forward into the future.
Wow, it's like a financial puzzle, figuring out how all these different losses and income sources fit together.
You said it. And the order you do things in can make a big difference. Let's look at another example, shall we?
Hit me with it.
All right, let's talk about Tasnam. They're juggling rental losses from multiple years. In 2013-2014, they had a £20,000 loss. And then in 2014-2015, they racked up another £15,000 loss, both from capital allowances and both eligible for what HMRC calls sideways relief. Now, their total income for 2014-2015 was £25,000, and they're looking to make the most of those losses.
Okay, so 2 years of losses, 1 year of income. Sounds like a challenge. What's the best way to tackle this?
Well, here's the key. Claim those losses strategically. Tasnam would first use that £20,000 loss from 2013-2014 to offset their 2014-2015 income. That leaves them with £5,000 of income still standing.
So they've completely wiped out that 2013-2014 loss, and they've still got some ammo left to chip away at the 2014-2015 loss. I like the way they think.
Right. And they would then use £5,000 of their 2014-2015 loss to offset that remaining income. That leaves them with £10,000 of the 2014-2015 loss to carry forward. Just by being strategic about which loss they claimed first, they managed to fully use that 20,000-pound loss and make a serious dent in the next year's loss as well.
Okay, this is making more and more sense. It's like a game of strategy. You got to plan your moves carefully to maximize those loss offsets.
Exactly. You've got to be thinking a few steps ahead. But let's throw another curveball into the mix. What happens when those capital allowances are actually bigger than the rental loss itself?
Now, that's an interesting twist. Does that throw a wrench in the whole system?
It definitely adds another layer of complexity. Let's imagine Pamela's situation. She's looking at a 3,000-pound rental loss for the 2015-2016 tax year. But here's the thing. Within that 3,000-pound loss, she's got a whopping 10,000 pounds in capital allowances. But she also had to pay 3,000 pounds in balancing charges, so it all works out to a net of 7,000 pounds in capital allowances. Now, her relievable income for the year is a healthy 35,000 pounds. So you'd think she'd be in a prime position to use those allowances, right?
With that much relievable income, it seems like she'd be laughing all the way to the bank, right?
You'd think so. But here's where HMRC throws in a little curveball. Even though her net capital allowances are lower than her relievable income, they're actually more than her total rental business loss, which was only 3,000 pounds.
Ah, I see where you're going with this. So even though she's got 7,000 pounds in net capital allowances and plenty of relievable income, her relief is actually capped at that 3,000-pound rental loss.
You got it. The amount of sideways relief she can claim is limited to her actual rental loss, even if the capital allowances within that loss are higher.
This is why understanding the nuances of these rules is so important. It's like playing a game where the rules keep changing. You need to be on your toes to come out on top.
Precisely. You got to be adaptable and think strategically.
Yeah.
And speaking of strategy, remember, Emmett, the one with the 30,000-pound loss and 35,000 pounds in capital allowances who was so eager to cash in on those capital allowance losses.
Oh, yeah, Matt. He was ready to claim that full amount without a second thought. What's the key takeaway for our listeners who might be in a similar boat?
Amit's case really highlights how claiming sideways relief isn't always a slam dunk. It's not just about grabbing the biggest deduction possible. It's about looking at the bigger picture. Remember that domino effect we talked about? How one tax move can impact other parts of your tax situation.
It's all connected.
Exactly.
Yeah.
In Amit's case, he needs to carefully consider if claiming the full amount, even though he could spread it over 2 years, is actually the best move for his overall tax situation.
Because it could end up biting him in the, when it comes to his personal allowance and his overall tax bill.
Precisely. It all boils down to crunching the numbers and figuring out the most tax-efficient approach for his unique situation.
This is why it's so crucial to have a knowledgeable tax advisor in your corner, someone who can help you navigate these complex waters and make sure you're not leaving any potential savings on the table. But for now, let's shift gears a bit and talk about a specific type of property that often comes with its own set of questions when it comes to loss relief: furnished holiday lettings.
So furnished holiday lettings, they used to be a bit more, shall we say, tax efficient when it came to offsetting losses against other income. But like all good things, those days are over. Since the 2011-2012 tax year, things have changed.
Oh, sounds a little ominous. What's the deal now for folks renting out their beachside bungalows or countryside cottages?
Well, you can no longer offset those losses from furnished holiday lettings against your general income. It's back to the drawing board. Those losses can only be carried forward to offset future profits from that same furnished holiday letting business.
So no more using those beach house rental losses to offset your day job income. Bummer.
Afraid not. HMRC closed that loophole a while back.
Mm-hmm.
The rules now are pretty much in line with those for your regular rental properties. It's all about playing the long game with furnished holiday lettings, knowing that some years might be more profitable than others, just like the stock market or the weather in the UK, right?
Always unpredictable. But hey, at least we're prepared now. So while those furnished holiday lettings might seem like they're in a world of their own, when it comes to loss relief, they're playing by the same rules as everyone else.
Exactly. Level playing field now, whether you're catering to vacationers or long-term tenants.
And with that, we've officially reached the final page of our trusty HMRC guide, which means it's time to wrap up this deep dive into the wild world of UK property loss relief. We've covered a lot of ground today, from those tricky capital allowances to the ins and outs of agricultural expenses. We even took a little detour into the realm of furnished holiday lettings.
We've decoded HMRC jargon, tackle those complex calculations, and hopefully given our listeners the tools to make smart decisions when it comes to those all-important tax savings.
Absolutely. But remember, dear listeners, every property owner's situation is unique. So while this deep dive has given you a solid foundation, applying these principles to your specific circumstances, that's where the real magic happens.
Think of it like this. We've given you the map, but you're the adventurer. It's time to go out there and unearth those hidden tax-saving treasures.
And remember, you don't have to go it alone. A qualified tax advisor can be your trusty sidekick on this adventure, helping you navigate those tricky paths and make sure you're not missing out on any valuable deductions. So, as we wrap up this deep dive, we'll leave you with this final thought. Remember that delicate dance between short-term relief against your general income and long-term offsetting against your future property profits. That's the million-pound question.
And the answer, well, it's not one size fits all, is it? But armed with the knowledge you've gained today, you're in a much better position to weigh those options and make informed decisions that align with your long-term goals.
On that note, we'll let you get back to conquering the world of UK property one savvy tax deduction at a time. Until next time, happy investing.